last month if you joined us during a webinar about minimum distributions during an account owner's lifetime. Now today we're going to spend a bit of time with an overview of RMD obligations after the original account owner's death. We won't be able to cover everything in just 15 minutes, but I do intend to discuss what I believe to be the most important principles that apply to stretch, and that's another name for post-death minimum distributions. And as Lisa mentioned, if you're interested in reading last month's issue of Think About It, which covers post-death required minimum distributions, Lisa will tell you how to request that at the end of this webinar. So let's talk about required minimum distributions from qualified accounts. And there are a lot of factors that are in play in deciding how much the minimum distribution needs to be for a beneficiary who has inherited the account. The post-death minimum distribution rules differ based on some variables. First of all, the timing of the taxpayer's death. Specifically, did the taxpayer pass away before or after the required beginning date? The second issue is the type of account. Is this a qualified account, as we're going to talk about today, or a non-qualified account? Is this a 403B account or another type of employer-sponsored plan? Those things matter. The third factor is the relationship of the beneficiary to the deceased. For example, is this a spouse or a non-spouse? That's the most important factor. And then finally, the timing of the stretch election. Sometimes if stretch elections aren't made in a timely way, some choices are precluded. And so all of that stuff matters in deciding what the minimum distributions might be after the death of the original account owner. The first factor that I mentioned was that the RMD choices will differ depending on whether the decedent died before or after the required beginning date. The required beginning date for most accounts is April 1st of the year following the year in which the taxpayer turned 70 and a half. For certain other types of qualified accounts, it's the year in which the taxpayer actually retired from the employer sponsoring the plan if the taxpayer worked after 70 and a half. And that would be for non-owner employees of a company. So if somebody turns 70 and a half in a particular year and dies before April 1st of the following year, they've died before the required beginning date. Even though they've reached 70 and a half, they've died before the required beginning date. And so the choices that we're going to talk about for a beneficiary where the decedent died before the required beginning date would apply in that circumstance. Even though the decedent was 70 and a half or older, if they died before the required beginning date, there are the special choices available. So a couple of things before we get too involved in it. First of all, minimum distributions are not required during the lifetime of a Roth IRA, a regular Roth IRA owner, while the Roth IRA owner is alive. And so always for a Roth account, we're going to treat it as if the decedent died before the required beginning date, because there is no required beginning date for a regular Roth IRA. On the other hand, designated Roth accounts do have required beginning dates. They are April 1st of the year following the year in which the taxpayer turned 70 and a half. And so the required beginning date rules do apply to those accounts. Another couple of quick tips. First of all, minimum distributions are the smallest amount that an account owner or beneficiary can receive. If a beneficiary wants to receive more, they can take more. And generally, with an inherited account, they can take more without any special kind of penalty. The only consequence of taking more is that the beneficiary will pay income tax on the actual amount received, so that might be a higher amount. And when we are calculating minimum distributions, we have to take a couple of potentially different tables into account, the uniform lifetime table and the single life expectancy table. If you go to IRS publication 590B, you can find those tables in there, and you can find the factors that we'll allude to during today's webinar in publication 590B. So if the beneficiary is a spouse, and if the deceased spouse had not yet reached the required beginning date, there are essentially two options available for the surviving spouse. The surviving spouse can treat the account as their own, either in place or by rollover to the spouse's own IRA. I will refer to either of those choices as spousal continuation. Treating the account as a spouse's own in place is technically not available for a spouse inherited 403B account. However, rolling that inherited 403B account into the spouse's own IRA is available. So that's the technique that must be used if you're dealing with a 403B account and you want the spouse to be able to treat the account as her own for minimum distribution purposes. Important factor in the decision-making process is that if spousal continuation is chosen, and if the surviving spouse is younger than 70.5, any of the distributions from the account are going to be taxed just like it's the spouse's own qualified account or IRA. And that means that distributions taken prior to age 59.5 from a spousal continuation account is going to be subject to the extra 10% penalty tax. That's one of the downsides of making that choice. One of the upsides is that the surviving spouse can name their own beneficiary for the spousal continuation account, and the beneficiary is going to be able to stretch based on the non-spouse beneficiary rules that we'll talk about later. So if the deceased spouse had not yet reached required beginning date, the other choice, other than rolling it over into the spouse's own IRA or otherwise continuing the account as if it were the spouse's own, is to treat the account as inherited. The couple of things about that. Minimum distributions can be delayed for the spouse beneficiary until the year in which the deceased spouse would have turned 70.5. That's a different requirement for beginning than for a non-spouse beneficiaries. But so this is available for surviving spouse only. If the account is treated as inherited, not as spousal continuation, but as inherited, RMDs can be delayed until the year the deceased spouse would have turned 70.5. The other thing is that if inherited account is chosen, any distributions for the beneficiary spouse are exempt from the 10% penalty tax, even if the deceased spouse is younger than age 59.5. So that's one of the decision points if you're working with a client who is the beneficiary spouse of a qualified account in deciding whether to elect spousal continuation or treat the account as inherited. Because with an inherited account, the penalty tax would not apply for pre-59.5 distributions. One of the give-ups on choosing inherited account is that the beneficiary's ability to stretch would be much more limited when they subsequently inherit the inherited account. I'm not going to go through the numeric example here because we don't have a lot of time. The points are that if inherited IRA or inherited account is chosen, the minimum distribution on the inherited account is delayed until the spouse, the deceased spouse, the first spouse, would have been 70.5. The example here goes through calculation, and if you're interested in the calculation part of it, I'd suggest that if you don't already have it, ask Lisa for a copy of the newsletter so you can go through the example, which is also contained in the Think About It newsletter that I alluded to earlier. So if the deceased spouse had reached their required beginning date and the surviving spouse is the beneficiary, what are the choices? The choices are similar. First of all, any minimum distribution that the deceased spouse didn't take prior to death for the year of death must be taken by the beneficiary spouse. The beneficiary spouse has the ability to roll the money over into her own IRA or also continue in place for qualified accounts if the plan administrator will allow. That choice is not available for 403B accounts. Inherited IRA treatment is also available after the spouse had reached the required beginning date. The first minimum distribution based on the surviving spouse's life expectancy will be due in the year after the deceased spouse death. And the way you calculate it is a little bit different than you would calculate it for a non-spouse beneficiary. There's an example here on the slide. You're welcome to look at it. I would also recommend, if you are interested in looking at it in a fair amount of detail, ask Lisa for a copy of the Think About It newsletter, and you can review it at your leisure. For non-spouse beneficiaries, they have much different options. They do not, the most important difference is they do not have the ability to treat an inherited qualified account or inherited IRA as their own account. They do have the ability to stretch based on life expectancy. That works assuming the beneficiary is younger. It's usually the beneficiary's life expectancy that you're going to use. And the option must be elected. The deadline for electing it is the year after, the end of the year after the decedent's death. That's when the first RMD would be due for a non-spouse beneficiary. And this example goes through the possibility that a non-spouse beneficiary inherited the account from her mother, and it goes through the calculation about how stretch might be elected beginning with the year after the decedent's death and how the stretch obligation would be calculated. So one other choice that a non-spouse beneficiary has is if the decedent had not yet reached the required beginning date, the non-spouse beneficiary has the option to completely liquidate the account by the end of the 5th year after the decedent's death. Well, don't they have that option anyway if they choose to stretch? The answer is yes, but the special thing that this gives the beneficiary is that they don't actually have to take out any distributions at all if they don't want to until the end of the 5th year after the decedent's death. Now, they'll have to liquidate the whole account and pay taxes on the whole balance at the end of the 5th year after the decedent's death if they choose choice B. But it is good to know that your beneficiaries do have that option. Your non-spouse beneficiaries do have the option of five-year liquidation if the decedent had not reached the required beginning date. One thing to note, too, is that if the beneficiary is a similar age or older than the original account owner, you have the choice of stretching based on either the beneficiary's life expectancy using the single life table or the decedent's remaining life expectancy at the time of death using the single life table. It seems a little bit counterintuitive to use the life expectancy of somebody who has already passed, but there you go. Congress and the President and the IRS have decided that that's the way the rule ought to work, and so that choice is available where the named beneficiary is actually older than the original account owner. You still you get the better of the two factors. You get to use the more generous life expectancy of either the decedent or of the named beneficiary. Numeric example for a non-spouse here in the slides. Feel welcome to, again, review the newsletter and study if you'd like to look at that in more detail. The non-spouse beneficiary cannot roll over an inherited qualified account to the beneficiary's own IRA. However, it is possible to transfer the inherited qualified account into an inherited IRA. And the inherited IRA would have the same minimum distribution requirements as the qualified account. Now, the key in that circumstance is that the money must go directly from the inherited qualified account to the inherited IRA. A 60-day rollover is not possible with a non-spouse inherited account. It is possible with a spousal account, not possible with a non-spousal inherited account. With a spousal account, transforming an inherited account to the spouse's own IRA can be done by 60-day rollover. But 60-day rollover is never available with regard to a non-spouse account. There are some special rules with regard to stretch. If the estate or a trust is the beneficiary of a qualified account or an IRA, stretching based on the age of the oldest beneficiary of a trust may be possible if certain requirements are met. If an estate is beneficiary, all stretch options may be lost except in very limited circumstances. And so, to the extent that you can, you want to encourage your clients to avoid naming the estate the beneficiary so that maximum flexibility can be retained on the backside with regard to minimum distributions and stretch. If there are multiple beneficiaries, sorting that out and separating out the inherited account into separate inherited accounts for each one of the beneficiaries by September 30th in the year following death will leave all of the stretch options open for each of the separate beneficiaries. So being aware of that deadline, September 30th of the year following death, where there are multiple beneficiaries, is a smart thing to do. So to wrap this up, and I know I didn't do the subject justice because we have a limited amount of time, but to wrap it up, the rules regarding beneficiary stretch options are confusing, even for experienced financial professionals. Helping your client understand the choices and the consequences of each of the choices that they might make is important. And in order to help the client make smart choices, you have to understand what the client intends to do with the inherited money. And also coaching people on the front end as they make their beneficiary designations about the consequences for those beneficiaries with regard to stretch. That's also an important consideration and something that you might ought to want to educate yourself about so that you can help people make smart choices on the front end so that their distribution intentions and the timing of taxation for beneficiaries are optimized. That would be good for you to know. We are available through email. Feel welcome to email any questions that you might have about today's topic or about other topics to asktheexpert@advancedunderwriting.com. I want to thank you again for joining us today for our webinar on stretch. And now I'll hand the microphone back over to Lisa so she can wrap this up. Lisa?
Thank you, Linus, and thank you all for joining us today. Like Linus said, please email us if you have any questions or if you would like to receive supporting materials at asktheexpert@advancedunderwriting.com. You may email any questions that you would like about today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Thanks again and best wishes for continued success.